Hello, everyone. This is Mark Manganello with the Bureau of School Finance, Department of Education. This is a training on district financial management oversight basics for a superintendent. So some superintendents have a real strong financial background. So a lot of the stuff you might not need this training. You might do not need just the basics. Also, new business administrators might also find this training helpful as you enter the profession. And also, this training is focusing on when the budget's been passed and sort of in your possession. That's when the financial management and oversight really needs to be done. So moving on. So the basic thing to understand is, what is a budget appropriation? So a budget appropriation is the authority to expend. And so every time you make an expenditure, it's going to be backed by an appropriation. So sometimes you'll see when you see like an appropriation report and an expenditure report, they could be the same thing if you spent all your money. However, you should have more appropriations than you do expenditures. Um, Generally. So just knowing the difference between what actually is a budget appropriation, and then also knowing that how the budget works and how your authority works. You can't expend more than you have. You can't spend more appropriations than you have. There's some particular ways in which you can increase your appropriations, which we're not going to get into. But generally, once your budget passes, say your budget's $10 million, you cannot exceed that. So you as a SAU, you really need to have a game plan to ensure you're going to stay within those budget appropriations. And you need to do that really before the school year starts. And then managing it throughout the year to ensure that you stay within those appropriations. And so you do that best by reviewing a budget to actual report, looking your budgeted amount to what you're expending, and then also using an encumbrance report to see how am I going to make it through the end of the year? What expenditures are obligated to pay? And then you might have some discretionary areas where you can maybe, if you have flexibility, you might have flexibility in your budget to ensure that you can stay under your appropriations total. Uh, Revenue. So essentially, it's how you're going to pay for that authority to expend. So say you have a budget appropriation of $10 million. All $10 million at some point or another needs to be backed by revenue. So you can only spend $10 million if you have $10 million. And so revenue is the money that comes in to support that appropriation. Um, so Building realistic revenue estimates is key to making sure you have the revenue to afford your budget, essentially. So at the beginning of the year, as you're forecasting, as you're building your budget during the budget process, but then once the budget's been enacted, and then the school year starts and you're actually operating under that budget, you should start to really have a good idea of what revenue is going to look like throughout the year. There's always some sort of wild cards that might come up, but by October, you should have a good understanding of what revenue is going to be throughout the year. And then, but things fluctuate. So always make sure throughout the year you're managing how much you budgeted for revenue, so how much you think you're going to get to revenue, and then what's actually coming in, and make sure you're staying on track. So if you budget somewhat conservatively with your revenue, it's not going to be a problem. You're going to have a good problem to have. You'll have more money than you thought. But if you had a big large estimates for revenue and the money's not coming in, you're going to need to respond quickly and address that. And then the next one is cash. So again, you have $10 million in a budget appropriation. It's going to be backed by $10 million in revenue. But if that revenue doesn't come in, you don't have money in your bank account, you really can't expend that authority because you need money in your bank account to expend that. So making sure you have cash in and cash management. Typically, it's about the timing of when the money goes out and when the money comes in. That's what a cash flow report is. But districts really, really strong balance sheets don't really need to worry too much about, how much cash do they have in the bank, because they know that if they're focusing on the budget appropriations, they're focused on the revenue. They don't really need to focus on when the cash comes in because they have plenty of cash at the moment. But analyzing the balance sheet and staying reviewing the balance sheet will tell you a little bit about how much cash you're burning. And ensuring that the cash you have in the bank accurately reflects what your financial reporting says. And so looking at cash reconciliation reports to ensure that the cash that is on your balance sheet is actually accurate. And whenever a school district's in a financial crisis or reaching out, and it might not be a crisis, it might just be having financial challenges, the first thing NHED does or DRA does is we typically go, okay, is this a budget problem? Is this an appropriation problem? Is this a revenue problem? Or is this a cash problem? And the answer could be all three, but just the way it's a good way to think about, okay, what is the problem? What am I trying to solve? Because um, uh, if it's a budget problem, then you can just really focus on that. If it's a revenue problem, you can focus on that and not focus on necessarily appropriations. So it can help focus your thoughts on where you need to think about as far as what needs to be done next or how do you solve the problem. So just these are the three buckets to which NHA really thinks about these problems. Another aspect of accounting that is important to know is the basics is this can get really technical as far as I'm not going to get too in the weeds here with the type of accounting, but just understanding the difference between accrual accounting and cash accounting. So accrual accounting is when revenue is earned. And when expenditures are incurred, that's when you recognize it. So say you provide a bunch of services in May, you would want to say, okay, well, we provided services in May. Uh, we expect to get paid for those services we provided in May. So we'd want to recognize that revenue as occurring in May. However, it might take a while for the check to come in the door. So the check might not come until next fiscal year, say, let's say July. Same with the expenditures. You pay for a lot of things, or you have you received a bunch of services in May, but you actually haven't paid for it. The money has not left the door, let's say until July. So you would want to recognize those expenditures as liabilities in May. You would want to recognize that revenue that you are going to earn in May, which means it's going to be in the fiscal year that's about to end. However, it might not actually leave your bank account until the next fiscal year. And so accrual accounting just allows this consistent, accurate way of determining what does your operations look like in that particular fiscal year that's ending, or fiscal year that you're measuring. What was the real revenue and expenditure activity in that fiscal year? Cash accounting would be that all of those transactions that should have occurred in May under accrual accounting, while the money never left the door or the money never came in until next fiscal year. So that's when you would record it essentially in the next fiscal year. And so the problem with cash accounting is a lot of small businesses do this. So large organizations do accrual accounting, accrual type accounting. Uh, Governmental accounting is under this version called modified accrual. So it's not pure accrual accounting. However, cash accounting would be recording all those transactions in July. So say you had a lot of expenditures in May and not a lot of revenue in May. You might be in a deficit to the end of the fiscal year, but you wouldn't necessarily know it under cash accounting because you wouldn't necessarily record it as being this financial loss until the next fiscal year. So accrual accounting helps you really understand your financial position and financial performance in the fiscal year in which you're operating under. And so there's this concept. Districts should not be doing this, but you can get away with this in cash accounting. You cannot do this under accrual accounting. This is essentially unlawful under state law. But if you try to take next year's appropriations or next year's funding and use it to pay for this year's expenses, that would be acceptable under cash accounting. So it's called this concept of looping. So basically just constantly being in a deficit and just trying to pay for your current year expenditures with next year's revenue. That is not sustainable. That is problematic. That is going to cause huge problems. It's going to mask potentially the problems you have for a short period of time. Don't allow that to happen. That is going to result in financial crisis. So that's understanding the concepts of how accounting works is useful for a super, so you can identify that problem if it's occurring and call it out and stop it. Another aspect of accounting is important to understand as a superintendent is what is fund accounting. So in the private sector, and a lot of business administrators come from the private sector, you don't do fund accounting. Basically, you have a company, and the company has a balance sheet. We have assets, liabilities, and equity. A company has revenue and expenditures, and you just lump everything as the company's financials. So in governmental accounting, you have fund accounting where you're segregating there's particular funds with particular legal requirements and restrictions, and that's where you're segregating everything. So the general fund obviously is the least restricted fund as far as the money, where the money gets, when money gets bucketed in there. So you have the general fund, you have the food service fund, you have a special revenue fund, you have these federal funds, you have capital reserve funds. So you're bucketing everything in these funds that have particular legal restrictions. And so that's just how government accounting works, and it's a requirement. And it's just different from the private sector. So a lot of business administrators struggle with adapting to the new form of accounting that they have to do for an SAU. I think one of the issues, this issue comes up maybe once or twice a year. Some district calls me up, and so this probably happens more because this is only the districts that call me up, but they'll call me up and they'll say, I was supposed to, there was a transaction that was supposed to occur and money was supposed to transfer from the general fund to this restricted fund. However, that never occurred. However, I know I still legally owe that other fund where that transaction should have happened, but it never happened. So now I'm dealing with a situation where my general fund's experiencing more expenditures than I expected. So therefore, my general fund I don't have as much money as I thought in the general fund, which is going to create financial problems. And they're like, I can't believe, they're upset because basically the transaction was missed. And so that's where a lot of districts run into issues as far as making sure that transferring between funds is done accurately and timely and nothing gets missed. And if money is owed back to one fund, it is done correctly in the system. And if money needs to come back to that fund, so all the interfund transfers, all of those aspects, that is where some districts get into a lot of trouble because fund accounting is challenging. The best you can do is you can talk to the Department of Education. We'll just help you troubleshoot a little bit and help you think about where to look. But really, it's you need to solve that problem yourself. I can't go into your ledgers, and your auditors are also really going to be your best resource there as far as if funds were moved around and you're trying to figure out where they went. Basically how to correct the journal entry, how to get your financial reports back to where they need to be. It can be challenging. And I think I see that a lot also with SAU turnover, where basically transactions were missed and funds were moved around and they need to be put in the right place. But the prior business administrator, the exiting business administrator did not get that done. Common issue I see. Go to the balance sheet. So again, this is the basics here, what a balance sheet is. Another way to think about a balance sheet is this is not necessarily a surplus statement, but it's telling you what your surplus is. So a balance sheet is a snapshot. So when you look at revenues and expenditures, that's looking at the full fiscal year. When you look at the balance sheet, it's at a moment in time. And so if you have a monthly balance sheet, that would be for the month end. If you have a quarterly balance sheet, it would be for the quarters, the last day of the quarter. And then if you fiscal year balance sheet, which is the DOE 25 contains, it's for the last day of the fiscal year. And so a simple way to think about balance sheets, it's what you owe. So that's assets. And then you back out what you that's what you own, and then you back out what you owe, which is liabilities, and that gets you equity. So we have 2.8 million in assets, and assets here are cash. So that's money in your bank. That's an asset. Then there's also receivables. So receivables are future cash. It's money that's owed to you that will eventually turn into cash. So it's an asset. So those are your assets. And a common thing in financial reporting is if you see large accounts receivable, you as a superintendent might want to have a conversation with your business administrator about, okay, these receivables look really large. Is that money actually going to come in? Are you billing Medicaid? Are these claims getting rejected? Are you billing for these particular services? Is this money, and you're booking this, seems to be booking this as an accounts receivable. Is it true that this money is going to come in? And then the BA would know, that's a good question. They might say, like, good question, good. Let's investigate this together to see if this money is truly going to come in, because you don't want to. Basically, when you say you have an accounts receivable, you're essentially saying on the balance sheet, I basically have cash. But if that money doesn't come in, it doesn't turn into cash, then you basically overinflated your assets. Not on purpose, but hopefully not on purpose, but just through the challenges of trying to do financial accounting. So liabilities is what you owe. So every time you make an expenditure, money leaves your bank account. Of course, that hits cash. So that's basically reducing your assets. But sometimes you have invoices coming in and they actually haven't left your bank account. Those would be payables. So these are things you owe. These are basically a future drawdown on cash. Would be your liabilities. And so a good thing to do as a super is to make sure all the liabilities are being put into the system. So if you're reviewing invoices and you see that um, what's in the system seems to be lagged substantially behind. So basically it's May and you're seeing these invoices that should be monthly and they're multiple months behind. So you're seeing, December invoices put into the system or being paid out. Uh, but it's May. That would be bad. So you'd want to say, okay, I don't think we're accurately representing how much liabilities we have. Why are we not current on our accounts payable? And that's a question as a superintendent you would want to have with your business administrator to understand what's happening. And maybe you misunderstand the frequency of the payment. There could be a misunderstanding, but these are the things, good things to look at in the balance sheet is making sure all liabilities are in place. So we have our assets is 2.8 million, and hopefully this is all accurate information. The other thing to test as a superintendent is when a financial report says it has $2.6 million in cash, that's money in your bank account. So um, that should be you can look at cash reconciliation reports and you can basically, is this money real? Is this money truly is this truly the cash we have? This is the cash we have in our financial reporting system. Is it truly the cash we have in our bank account? And so the cash reconciliation process will asking for those reports or making sure those are getting done. Every business administrator does this, but your job as the super is ensure that basically what needs to get done is getting done. Um, Another way to investigate that. So we have assets of 2.8 million. We have liabilities of around 800K. So that means we have equity of $2 million. We have more assets than we have liabilities. So we basically are, it's kind of a surplus of $2 million, which is great. It looks like with this particular school district, some of that they voted from fund balance. It looks like they're retaining some of that money. So they took that $2 million and they decided during district meeting, they voted from fund balance 316K. They've made a decision to retain 700K, and then they're looking to give back almost $1 million back to the taxpayers. And so this is a key number. This is your school board. Now, your school board is always going to be focused or should be focused on this number. How much money are you giving back to the taxpayers? So almost every single district has more in assets than liability. So almost every single district is able to give money back to the taxpayers, which is a great thing. Districts that are deficits cannot do that because they have zero equity. They have more liabilities than assets. Negative equity. So this is great that you can give $1 million back. What your school board is focusing on, what you should be focusing on, is that true? Are my assets real? Are my liabilities fully recorded? Is everything in the system correctly? Because I'm saying I have $2 million, but I only truly have $2 million if this is all accurate information. So making sure it's an accurate financial report is financial management and oversight. And then the financial management aspect is what your school board's going to want to talk about is, okay, we're going to give $1 million back to the taxpayer. That's great. And technically we can afford to give them this almost 1.7 million. However, the school board made the decision that we want to hold on to this as like an emergency fund or a future tax cut, or we don't want to have the tax rate decrease by too much this year. We want to have it decrease by X amount, and then we're going to decrease it more next year. So this is financial planning and financial management that your school board's going to do, but you as a super and BA, you're going to help your school board make those decisions or understand those decisions that they're going to make. So balance sheets are extremely important. So what it's also important to understand as a superintendent, a lot of you come from of course, a lot of you are educational background. Your number one mission is to be the educational leader in your community. That is in statute. That is your job as a superintendent. You are the educational leader in the community. Your school board is the governing body. Your school board is going to obviously set policies and do what's responsible for them. Your local legislative body is going to set the budget through their process. But you are a expert and leader and professional relative to education in the community. That is your job number one, and making sure the students are learning is your job number one. But in addition to that, under statute, you have a lot of other responsibilities. You also are the administrator, the CEO, the CFO. I mean, the BA is essentially the CFO, but you are doing all the administrative work, which is necessary to keep your institution running. So making sure all aspects of education, so the transportation's working, nutrition programs working, all of the alternative programs that might exist are working. So ensuring the lights are on and the school is running is part of your job. And so it's important to understand is because some school districts that get in trouble is they really just focus on the learning, which is great, but you can't just focus on it. You do have to focus on operations. You do have to make sure everything's running smoothly. You have to make sure financial reporting is being done correctly. Because if financial reporting is not done correctly and you find out there's financial mismanagement, it's going to be really hard to educate students when your school district is basically finds out you don't have resources. You're not going to be effective leader in the education, an effective educational leader if you're not doing those operational things to make sure your school district is running. And so don't neglect financial reporting as a superintendent. It is a key aspect to ensure your school district's running. And so a lot of superintendents too, if you don't have any, maybe you didn't take any financial classes in college, one of the basic things you could do if you don't want to get into the weeds is any financial information needs to be one, timely, and two, accurate. So if you have inaccurate information, and you define what is accurate, if it's an estimate, it doesn't need to be perfectly accurate. So the materiality of it, you define. The timeliness also you define. Your school board sets policy, you set policy as far as what information do I need to see and when. So thinking about information needs to be timely so that you can act, and it needs to be accurate so you can act appropriately. So timely could just be routine reports, monthly reports. If they're not in monthly, they're not timely. And so you might say, I need this report every month because, every month I'm going to do X, Y, and Z. I only need this report every quarter. So because I'm going to act after, 3 months. So being timely is about getting the reports in on time. But also being timely is recording the transactions. So this is a big issue I see with SAUs is they tell me, I'm trying to close month end and I get this invoice, and typically it could be a large invoice. I get this invoice for a special ed payment that I didn't know about. That's $100,000 and it's a surprise. So anyone who's sitting on invoices, we go back here. If you're sitting on invoices, that's going to be a big problem because you're not going to know your liabilities at the end of the fiscal year, and you're going to misstate your financial position, and then you're going to give money back to the taxpayers that you don't have. So sitting on invoices is, and it's typically people get the invoices in, but getting them in timely so people can act and people can manage their finances is really crucial. Being accurate. So this is just having sufficient review process. Sometimes the business administrator is sort of the only person who's looking at this stuff. Of course they hopefully have an accounting team to help them get all the system into the ledgers but making sure it's accurate, making sure there's a process to get information out accurately. So you as a super, you have a responsibility to ensure that financial information is accurate. Being reliable. So all transactions need to be sourced in some way or another. You can't just say, this is, this money went out the door, this money came in. It has to be sourced. There has to be some sort of documentation to explain why it came in, what came in, how much came in. So there's got to be some sort of documentation to prove that money is real, and it's not just, comes out of thin air. So auditors are obviously looking at documentation and assessing the documentation. You should have policies and procedures relative to documenting transactions. So timely, accurate, and reliable are probably the most important things. Being consistent, whenever you're doing reporting, if you change your reporting methodology every 3 months, you're really it's not gonna be useful reporting. So being repeatable, being able to do it year over year, consistently is going to make the reporting more effective. And so you do that through policies and procedures. I need to receive this report and it has to be shown in this particular way in order for me to understand and track trends. So if you're constantly changing the reports, that's potentially going to be a problem. So always ask why before you change a policy, process, or procedure. Why are you doing this and what's the rationale for it? The other thing is integrating financial reporting to business processes. So I talk to school districts. Some school districts, the BA is always going to be the champion for good financial reporting. That's their job. But everyone should care about financial reporting. Everyone should care about staying within budget and not going over budget and not creating financial problems for the entire school district. So integrating it into the culture is going to be helpful. So it could be you as a superintendent have a standing meeting with your principals, and maybe the first thing on the agenda is talking about areas related to the classroom, and again that educational mission aspect. But also on your standing meeting, hey, we're going to talk about the budget, and I'm going to make sure we're that it's important that you stay within your budget, setting that tone, setting that culture, or we're going to talk about how we're going to get financial information into our system or whatever may be necessary. But setting that culture at the top and trying to integrate financial management into more aspects of your operations is going to be positive. So this is the tax rate formula for those that don't know. It's a lot of DRA forms. So the budget appropriation is your MS-22. That is a DRA form. So essentially, you passed your budget. Let's say you passed a budget and it was $10 million. That's going to be, you're going to send an MS-22 to DRA, and we're going to know, the state's going to know now that you have authority to expend $10 million. So you're going to need revenue at some point to fund that $10 million budget in order for you to have the ability to expend it. So what DRA does is they back out all non-local property tax revenue. So the first thing they're going to back out, or at least in this example here, is the unassigned fund balance. So that's going to be revenue to fund next year's next fiscal year. So as you end one fiscal year, you're going to say whatever money you have left over, you're going to use it to fund the next fiscal year. So again, this is the UFB. So in this example here, it's 982,000. In this example here, we're going to say it's 500K. And so that's why your balance sheet needs to be accurate. So if it's not, you say you have 982K, you say you have 500K, is that real? Or did you not have correct amount of assets or correct amount of liabilities to correctly determine your fund balance that you can give back to the taxpayers? So we're going to fund it right now, this $10 million, we're going to fund 500K through the UFB, the unassigned fund balance. The next thing we're going to look at is non-adequacy, non-swept related revenue. That's the MS-24. So that's a form that the business administrator fills out. So all revenue that doesn't relate to adequacy and swept, this could be your federal grants, this could be tuition revenue coming in if you have school districts, students coming into your district. Any sort of revenue that's not related to the DOE 20, or not related to the UFB, and not related to adequacy or swept. This could be building aid, a bunch of other state grant programs. We're going to tally that up. That's $1.5 million. And then adequacy or swept, this is going to come from my office. We're going to send out a spreadsheet. We're going to send out a spreadsheet that tells you this, but then we're also going to send out checks that pay for adequacy. So the money's going to come into your school district from the state. Also swept is calculated by DRA, and that money's going to go from your local tax collector to the district. So that money's going to come into your district. And so we've tallied up all this non-local tax revenue, UFB, MS-24, adequacy. We've got $5 million here. So we've got $10 million budget. We've got $5 million to fund it without using local taxation. So we need another $5 million. And so again, the importance of this is we're going to back this $10 million budget with all this revenue. If the MS-24 is incorrect, if the DOE 25 is incorrect substantially, if adequacy is incorrect, hopefully we didn't make a mistake there, it's going to cause a problem with your budget. You might have an issue with your finding $10 million. So, but DRA is going to set the tax rate and say you need another $5 million. So they're going to go $5 million with just the tax effort or tax assessment. And then they're going to look at that MS1 form, which we'll talk about later. But that's basically all assessed property values. This is not equalized. This is just the raw assessed data that your town assessor. The school district has nothing to do with this. This is a local town issue, town process, but the town's going to pass in give DRA the assessed property values. And so you go 5 million over, let's say you have a $1 billion in property values, assessed property values. You have a tax rate of $5 per thousand. And so that's going to, that's how you set a tax rate. And so this is all set through these DRA forms. So the first one we talked about was the budget appropriations, which is the MS-22, which is what your voters passed. It gives you the authority to expend. But before you did that, you had to give DRA what was your proposed budget, and not only what was your proposed appropriation. So what were you hoping to get the voters to vote on and approve potentially, depending on well, maybe not hoped on, but whatever was presented to the voters. That's the appropriations as well as the revenue. So you guessed it. You guessed about what do we think is going to come in for the federal government? What do we think is going to come in from tuition revenue? So you gave estimates on revenue and what you're thinking would be the appropriations. Then the vote of the legislative process happened. They decided what the number is going to be. In our example, on the last slide, it was $10 million. So you've got one aspect of the formula variable to set taxes. The next one is that MS-24 estimate. And keep in mind, the school board is signing off on this. So you were a school board or at district meeting. Probably very likely you're at district meeting. You know what happened. You're going to sign off on the MS-22. There's also documentation. There's minutes and all that other documentation to validate it. There's warrant articles and vote totals to validate this. But the MS-22 is going to get submitted, and your school board members are involved in that. The MS-24. It's just required that the BA does it. And it's basically going to take this number here that you estimated for revenues, and it's going to revise it because the first day of school might happen and you might say, okay, well, we thought we were going to get, $1 million worth of tuition revenue coming in from all the students. However, first day of school happened and the students we thought were going to show up did not show up. Therefore, we got to decrease that number because it's not going to be as high as we thought it was going to be. So getting that MS-24 is correct is incredibly important, just as important as all these other components. And then the DOE 25 is going to come in. That is going to get the board to sign off on. The board is going to sign off on that. And so again, that's going to determine that UFB, that unassigned fund balance, that will be used to reduce taxes. And then lastly, the MS1. MS1 is a town assessor is going to provide in that locally assessed values, and that's going to determine the denominator in the tax rate setting ratio. So a couple tips here on tax rates. As the end of the year progresses, always try to always be thinking about how you think you're going to end the year. You think at the end of the year in a surplus or a deficit, and it'll become more clear as the year progresses. We try to close the books in July and August. So again, you can't close the books July 1. You got to take some time to make sure all the information comes in. But if you have good processes and everyone's timely with everything, getting the books closed quickly is going to really tell you what's going on. One issue too, as you close the books, you're basically going to finish the last fiscal year. However, if you had lingering issues from the previous fiscal year, so you closed the books last fiscal year in, let's say, August, then auditors come in and made a bunch of adjustments and said, as you closed the book last August, some issues were found in the previous fiscal year, and you need to make adjusting journal entries. If those journal entries were never made, if those adjustments were never made, then the person trying to close the books this summer is going to run into issues with starting balances. So this happens, and this is another issue with SAU turnover. Basically, if you're changing BAs and one BA was supposed to make these audit adjustments, but they were never made, could be a problem. It's just going to create a huge headache for the incoming BA. So making sure all audit adjustments and you have clean starting data, the correct starting balances to start the year. And also getting your audits done timely. So getting your audits done and not being late on your audits is obviously crucial. Waiting on MS-25 signature until you're confident in the fund balance returning to the taxpayers. Again, you can make your first run of your financial reports. However, after NHS review, DRA's review, and then potentially if your auditors are already doing some field work, they might have some comments about your what they think your fund balance might be based on their review, or where you think you might have mistakes in your fund balance. So just waiting a little bit to make sure you're really confident in your fund balance you don't want to delay tax rates, but it can make sure you have an accurate tax rate. Take advantage of auditors if possible. So auditors are there to, you typically hire them to give an opinion on your financial reports. That's super valuable information. You need to know if what you've been reporting to, NHED, DRA, the public, you need to know if it's accurate, or, if, in the opinion of the auditors, they can provide absolute assurance, but they can provide reasonable assurance that you followed the correct amount of processes to produce an accurate financial report. That is their number one objective is making an opinion on the financial reporting you're doing. But they can also provide essentially free consulting. So if you wanted an audit firm typically has they have a consulting wing, and then they also have an audit wing. So you're engaging with them for their audit services. The consulting services would be totally separate from that. And if you wanted them to do something robust, you would use them as consultants. But where they can provide kind of free advice or free consulting is engaging conversation with them. So asking the auditors, hey, I know you gave an opinion on our financial reports. You saw our operations, you saw our policies, you saw our procedures. What do you think is most risky about our operations? Where could you see a problem occurring based on how we run things here? You could ask the auditors just, what is our capacity? Do we have enough staff in our business office? Do we have trained staff? Does our staff know our processes? Does our staff know what they need to do? Is there gaps in training that we need to do? So is there any gaps in our processes? They might not put that in the report. That could be in the report if it's a problem, but if it's not, worthy of a problem, they might just give you some verbal advice as far as what you can do as a manager, as a SAU, to ensure better financial management. And auditors want to help. Auditors want you to have really good accounting so that when they come in, they're confident that you have good policies and procedures so that nothing bad will happen. Auditors don't want bad things to happen. You should not want bad things to happen. So they want to help. Auditors hate fraud, waste, and abuse. So if you engage in conversation with them about fraud, waste, and abuse, they'll tell you where the risk might be. They might not be able to prove that fraud, waste, or abuse happened. But they might say, there's some risk here for fraud, or risk here for abuse, or risk here for waste. So they'll point that out for you. Sometimes just verbally. If not in the report, it might be worth documenting in their opinion, but they're going to do their work. The MS-24 tips, tuition revenue, I think, is the one that could change mid-year. That's the one that could be, that's the one that's hard to keep track of, is how much money is truly going to come in. You do pretty much know that at the beginning of the year. However, students could leave. So keep an eye on tuition revenue. Another thing to think about is our budgets are gross appropriation. So all federal money needs to be appropriate. All federal programs that you're going to run at your local school district need to be appropriated. So if you have a $1 million program that supports Title I students, you need to have a $1 million appropriation to fund those services that are going to be funded by that grant. But that's going to be on the MS-22. And then on the MS-24, if you have $1 million in federal grants, you should have also $1 million in federal revenue. And so basically it would wash out. It would have no tax impact if the money shown on the MS-22 also matches the money on the MS-24. Same would be true if you were having bonding a large project. You would have the project on the MS-22, and then you'd have the bond revenue on the MS-24, so it would wash out, and then the tax impact is likely, and depending on how you structure it, definitely going to be the debt service. But the tax impact, you wouldn't want them to pay the taxpayers to pay for the full building project all at once. You would want to recognize that bond revenue. Same with food service revenues. Food service revenue, typically they're not fully neutral. Typically, you need some general fund money to come in there. And so sometimes districts will budget for that. Some districts, bunch of different ways to do this. But generally, you want to make sure that your food service appropriations and your food service revenue matches with the understanding that you might need general funds to fund your food service program. But again, making sure those things wash out correctly to make sure you have accurate tax rate setting. A couple things, a couple common pitfalls. So the most common pitfall is district runs out of appropriation. This could be self-inflicted. It could be just unexpected. Either way, you have to manage through it. So it might not be your fault, but it's going to be your responsibility to manage through it. If it's an unexpected cost, you will have to manage through it. If it is due to poor budgeting, that again, you'll have to manage through it. But it might be something you could have fixed in the first place. So having quality budget reporting, looking again at the budget to actuals, looking at those encumbrance reports, making sure you're staying on target with your budgets. Having a culture of staying under budget or staying within budget throughout your organization is going to be helpful. Having expenditure controls as needed, so making sure you can, if you can't afford something, you can't expend it. So having expenditure controls as necessary. Having reserves is going to help you manage through problems. So whether it's retained fund balance or capital reserve, some sort of expendable reserve for when problems come up. Fixes. So you might just have to cut spending to fix this issue because you cannot exceed your appropriations. You might have retained fund balance authority, so you might be able to go there. You might have expendable reserves, so you can go there. And then you might have 3211 is a process. We're not going to get into the details of that, but that's a process to get an emergency expenditure approved by the Department of Education. So that's how that's running out of appropriations. And then again, focusing on the appropriations is key, and everyone typically focuses on the appropriation, but you don't want to neglect revenue. So district runs low on cash, or revenue does not come in, or does not come in quickly. Those are different problems. But again, we talked about in the beginning, whether it's a appropriation problem, it's a revenue problem, it's a cash problem, could be all of the above. So having to manage cash flow, having really quick quick accounts receivable and billing turnaround, that's going to help you manage cash flow. Having good revenue is going to just be basically it's going to be, did you have quality MS-24 reporting, and did everything on the MS-24 you said was going to come in? Did it come in? If it does not come in, then you have a revenue issue. You're basically going to be potentially looking at a deficit, and so. In that situation, you might have to start cutting expenditures. But having quality MS-24 reporting, having quality revenue estimates, making sure the revenue's coming in, making sure the revenue's coming in quickly is gonna prevent these issues. So if you weren't able to prevent it, some of your actions might be to work with a municipality on a tax payment schedule. So your municipality is going to pay you taxes as they are required to, but you might want to say, hey, can we get that 30 days in advance? Because we're running low on cash, and your municipality might say, no, we can't do that because then we'll be running low on cash. Working with your vendors to see if you can delay some payments if you have to. Not a great idea. None of these are great solutions, but your vendors, you don't want to make your vendors upset because you want to maintain those relationships, and they want to be confident that when they do business with you, you're going to pay them. But you might have to do that depending on the situation. Budget freezes and cuts might be needed, so you might need to freeze some aspects of your spending. You can also get a loan against adequacy if you have a short-term cash issue, depending on the time of year. The other issue is district. This is also very common. District decides to dramatically cut funding via action by the legislative body. So we know that planning for future reductions in cost expenditures is better than this sort of dramatic. Planning for this is better. Planning allows communities and students to all adapt to changes. However, sometimes for whatever reason, the legislative body does not want their taxes to increase, and they do want their taxes to go down. And for whatever the variables of the situation are, they'll make cuts, and the cuts will be maybe larger than you're used to, and might be harder for you to manage through. So this does happen as well. So the preventative thing, it's hard to say how you prevent this. Some of this is political, but what you can probably do from a management perspective is work on having a stable tax effort. So make sure you're consistent in your tax effort, building trust with the community. So when you say, taxes, if you say taxes are going to go down, but then taxes go up, that's not going to help you build trust. So being honest and accurate with your work builds trust. And then being stable with the tax rate. So don't just, have the tax rate drop dramatically one year to have it go up the next year. That's going to create chaos and confusion in your community because they're going to want to understand why that's happening. And it might be hard for you to explain. And then, of course, just keeping in mind, just being a good steward of taxpayer dollars and demonstrating that to the community is important. So how do you fix this? How do you fix these dramatic cuts? You can sometimes delay the inevitable with short-term solutions like exhausting all reserves. Not to say that's a common choice the school board will make because they look at these cuts and they look at the reserves and they go, okay, well, we don't have to experience them this year. However, we think we have another chance at the next budget cycle to maybe get these cuts restored. That is an option available to you, or maybe an option available to you if you have reserves. The problem I see is a district makes a lot of cuts through the legislative process in March. Then SAU administration really has, and the school board has a short term to act. So basically, you're signing teacher contracts in April. So like right after you make these cuts, you have to start thinking about what is my workforce going to be? What is my teacher? How many teachers am I going to have? So basically having a plan from the get-go as far as when if you have dramatic cuts, what are you going to do to make sure you can implement those cuts? The timeline between March and July is shorter than you think. So some basics are relative to financial management is this concept of internal controls. So internal controls apply to all aspects of management. It's the policies and procedures and reviews that management establishes to ensure transactions and reporting is accurate, timely, and reliable. So internal controls would be if you're reporting on any aspect of your operations, anything you're trying to measure, you need to have policies and procedures and processes to ensure that's done timely and accurately. So your auditors will talk to you about internal controls and how to set up the best policies, procedures, and processes to ensure your financial reports get done correctly and timely. So knowing your internal control system and knowing how important it is a responsibility of the SAU administration. Then also knowing that external controls, so your independent audits are great. Obviously, you're required by law to get audits. But they're not your internal control system. So you can't depend on audits to fix your problems. You have to have policies, procedures, and processes to find problems, detect problems, prevent problems from happening in your internal control structure. Your audits are just obviously, on top of that, they also look at your internal control system. State oversight, again, state might find issues. State can sometimes point out issues for you, which is, not great, but it's better than them not being pointed out. But state oversight can also be an external control and finding problems that you might be having on with your school district. Public scrutiny, so being transparent with the public, and some citizen of the public might notice there's an issue going on and might alert you of it. So being transparent is a good way to improve your external control system. The other thing to think about too is whenever you're doing an internal control, so you want to think of the cost of that internal control, and it can't exceed the real or potential benefit of implementing that control. So consider materiality. So if you had a $5 invoice and you had 6 people review that, clearly that's the cost, the risk of that $5 being misappropriated or whatever may be the risk, not worth six reviews because the cost of labor for those reviews exceeds the $5 invoice, the risk of the $5 invoice being done incorrectly. So always think about when you build an in-control system, how to do it most efficiently, how to be most efficiently effective in ensuring that whatever your objective is gets achieved. And then obviously when talking about controls, you can have a conversation with your auditors about what kind of controls you have and are they effective and efficient. And then again, just say this again, it's called the tone at the top, but the super and the BA are the super is the top leader in the SAU, and same with the BA. You got to lead by example. So you set the culture, which reinforces strong controls over finances. So by the super and BA following the internal control structure, you set an example that the internal control structure is important and needs to be followed. So principals and teachers, as administrators, you're there to really support the teachers and teachers and principals to ensure that they can support the students. And that's how this works. But everyone needs to support the control system. So whatever your policies, processes are to ensure financial management gets done correctly and financial reporting is done correctly and accurately and timely, everyone needs to support that internal control system. Within reason here, you can't have an internal control system that overly burdens your teachers or principals. So keep that in mind. The internal control system you have to design that in a way that's going to be most effective and efficient to achieve your objectives. But making sure everyone knows it's everyone's responsibility to do financial management is the type of culture you can set. And that's it for my training. Thank you.